Good morning, guys. Welcome to Mug Briefing. On March 12th, a Bloomberg analysis revealed something that made a lot of investors pause for a second. Microsoft and Meta had each added nearly $50 billion in new data center lease commitments in their most recent quarters. Not total spending, not immediate cash, but new, long-term promises to rent massive computing facilities. And when Bloomberg zoomed out, the number became even bigger. Across the major cloud giants, Microsoft, Meta, and peers like Alphabet and Amazon, the industry now carries more than $700 billion in future data center lease commitments. That number is about infrastructure, but the real story is what it quietly does to the financial structure of these companies. Because a lease commitment is basically a long-term rent contract. Once signed, the company owes those payments whether the buildings are fully used or not. So the first question investors immediately ask is simple: what actually changed financially? Those $50 billion commitments don't hit cash flow today. They unfold over years, sometimes decades. Most hyperscale data center leases run 10 to 20 years. Spread across a timeline like that, a $50 billion commitment could translate into roughly $2 to $4 billion per year in lease payments, depending on contract length, escalation clauses, and how the facility is financed. But that's only part of the cost, because renting the building is just the shell. The company still has to fill it with servers, networking equipment, cooling systems, and power infrastructure. And those hardware installations often cost as much or more than the building itself. So a single large data center campus can easily require billions more in capital spending beyond the lease. Now zoom out for a second. The leases Microsoft and Meta added this quarter increase their total future obligations, but the companies already had huge commitments on the books. Meta's filings show about $103.8 billion in total lease obligations, much of it tied to data centers that are still being built. Microsoft's infrastructure commitments are even larger, across operating leases and finance leases tied to server campuses. So when Bloomberg says each company added about $50 billion, that's incremental, new commitments layered on top of an already massive pipeline. Here's where it gets interesting. Many of these facilities are already under development or planned. The leases typically secure land, buildings, and long-term power capacity years before the servers arrive. That means the commitment is real, but the exact payment schedule, utilization level, and final cost structure often isn't fully visible to investors yet. Companies usually disclose the total lease obligation, but not every annual payment in detail. And some contracts contain inflation adjustments or power cost pass-throughs, which can raise costs over time. So the 50B headline is a commitment, but the precise yearly expense is still a model assumption investors have to estimate. Now, think about margins. Margins are basically how much profit a company keeps after expenses. When fixed costs rise, things like rent, power contracts, or depreciation, margins usually get squeezed. These data center leases do exactly that. Depending on accounting treatment, the cost may appear as operating lease expense or as depreciation plus interest if it's structured as a finance lease. Either way, the effect is similar. Expenses rise before the revenue arrives. That means near-term free cash flow, the cash left after spending, can fall during the build-out phase. And this is where investors start asking whether the market already expected this, because the AI boom didn't appear overnight. Over the last 2 years, investors already watched hyperscalers spend aggressively on chips, servers, and facilities. Stocks like Microsoft and Meta rallied in part because investors believed AI demand would justify the spending. So some level of infrastructure expansion was already priced in. But the scale revealed in the Bloomberg report made many investors realize something. The AI race may be even more capital-intensive than expected. And this is where the ripple effects spread. Data center landlords, often structured as REITs, are obvious beneficiaries. They build the facilities, then lease them to hyperscalers for decades. Utilities benefit too. Data centers are some of the most electricity-hungry buildings on Earth. Each new campus requires massive grid connections, substations, and long-term power contracts. Then come the hardware suppliers. Companies like NVIDIA, AMD, and Intel ultimately supply the chips that fill these racks. But landlords and lenders carry their own risks, because in many leases, rent is owed even if the building isn't fully used. That means hyperscalers, not the landlords, usually carry the utilization risk. And this is why investors keep asking one uncomfortable question. What if AI demand doesn't grow as fast as expected? If model efficiency improves faster than anticipated, companies might need less computing power per AI system. If enterprise adoption slows, servers could sit idle. And if electricity becomes scarce, which is already happening in some regions, data center construction could be delayed. Interest rates matter too. Large infrastructure expansions often require debt financing. Higher borrowing costs raise the total price of these commitments. But that's only the bearish scenario. The bullish version looks very different. If demand for AI services keeps exploding, training models, running chatbots, powering enterprise tools, these facilities could become the backbone of the next generation of computing. And whoever locks in capacity first could gain a huge advantage. Which brings us to the competitive angle. When one hyperscaler signs massive capacity deals, rivals feel pressure to match. So investors immediately wonder whether this pushes competitors like Amazon or Google to accelerate their own infrastructure spending. That's how infrastructure races begin, not slowly, but step by step, announcement by announcement. For investors, the practical implication is subtle but important. Near-term free cash flow may look weaker. Capital intensity, meaning how much money must be reinvested to grow, could stay elevated for years. That can compress valuation multiples, which is basically how expensive a stock looks relative to its earnings. But the same infrastructure could also unlock huge future revenue streams if AI demand materializes. And that's the balance investors are trying to figure out right now. Because committing to $50 billion in data centers does not guarantee future revenue. It doesn't mean $50 billion will be spent immediately, and it certainly doesn't mean AI demand is already locked in. It simply means these companies are betting enormous sums that the future of computing will require far more infrastructure than exists today. So the next clues won't come from lease disclosures. They'll come from something else entirely. Upcoming earnings calls, customer contracts for AI services, power supply agreements, and most of all, whether these giant facilities start filling up with real workloads. Because the difference between a brilliant long-term strategy and an expensive overbuild usually only becomes clear after the servers turn on.